Hello everyone. In this chapter 4, we're going to discuss the various journal entries that you would typically see in governmental funds, most likely the general fund, and also towards the end of this lecture we're going to take a look at some journal entries we would see in a permanent fund. Okay, before we get started, what I wanted to explain to you is that the way this semester is going to work with the lectures is when we look at journal entries, above the journal entry number, you are going to see where the journal entry is going to be recorded. And another thing that we're going to understand in this semester is that we are going to use what's known as a dual entry approach. And what that means is we are going to look at the journal entries in the governmental fund, or I should say in the fund in general, and the government-wide statements at the same time, side by side. So with that said, you are going to see that some journal entries are recorded in the fund only and not in the government-wide statements. Some journal entries are the same in the fund level and the government-wide. Some journal entries are similar yet a little different between the fund and the government-wide. And some journal entries, and I will show you one tonight, where the transaction is completely different between the fund level and the government-wide. All right, so first journal entry of the year, as we learned in the last chapter, the last lecture, is the budget. So the budget is recorded as the first journal entry of the year. And once again, the reason we record the budget is so we can keep track of those budget balances throughout the year. So we're going to record the budget for revenues with a debit to this account called estimated revenues. We will credit the appropriations. This is the budget for the expenditures. The difference between the two, whatever is needed, we will debit or credit this account budgetary fund balance. Once again, this is the first journal entry of the year, and this journal entry is recorded so we can keep track of the budget balances throughout the year. That purpose having been served, and the last journal entry of the year, this budgetary account will be reversed. We will always wind up with zero balances in these accounts. All right. Journal entry 2. After we record the budget, one of the next journal entries is typically to record an encumbrance. Remember, what an encumbrance is basically when we signed a contract or we sign or we enter into a purchase order that the contract or the purchase order has been unfulfilled at the signing. And so at the signing, what we do is we encumber those funds by recording this journal entry. We will debit encumbrances and we will credit encumbrance outstanding. The reason for this journal entry is to put a placeholder on those funds. An encumbrance, just like an expenditure, reduces the amount of available budget balance. The encumbrance account is a temporary account, and the encumbrance accounting is as well, but the encumbrance outstanding is like a little carve-out of one of the fund balance categories, most likely assigned fund balance. The next journal entry, as you can see, some of that contract that we signed for $59,090, some of that contract has been fulfilled, and it is a two-step process to do so. So you can see journal entry 3 is a partial reversal of journal entry 1, where we're going to debit the encumbrance outstanding, and we will credit the encumbrances. And immediately at the same time, after reversing the encumbrance, we immediately replace it with the actual expenditure. And we will do so by debiting the expenditure and crediting the accounts payable. You can see that the encumbrance was $22,415. The expenditure is only $21,700. That's okay. Remember, the encumbrance was a contract or a purchase order, and sometimes that may not be the exact ending amount. There may be some slight differences. Maybe the contract has some items that are subject to fluctuations, or maybe there are some shipping charges, or maybe there are some discounts we were able to take advantage of. Bottom line is the actual ending expenditure may be a little bit different than the encumbrance, and that is okay. Okay, up to this point, you can see that the budget journal entry, the encumbrance journal entry are recorded in the governmental fund, the general fund only. But the expenditure is recorded in the general fund, and at the same time, this is the dual approach I was telling you about. At the same time that the expenditure is recorded in the general fund, if you come down to the bottom of the screen, you can see that the expenses for the government-wide statements, we're going to record this journal entry. It looks similar, but it's a little different. Once again, at the general fund, the governmental funds use modified accrual, and we will call them expenditures. At the government-wide level, we use accrual accounting. And with accrual accounting, we use the term expenses. And another thing that's unique about the government-wide statements, if you recall from our prior studies, we actually record the expenses by function or program, and we don't accumulate them all at once. All right, journal entry 4A, another contract has been signed. So we will debit encumbrance, credit encumbrance outstanding. Once again, encumbrance accounting is for the fund only. And journal entry 4B, we can say as soon as that encumbrance was entered into, it's been fulfilled. So journal entry 4B, as you see, is a complete reversal of 4A. And so the encumbrance has been fulfilled. We reverse the encumbrance. And right after 4B is recorded by the general fund, 4C is recorded at the same time. You can see we're recording the actual expenditure. And even though the encumbrance was for $15,000, the actual expenditure was for a little bit less. And that's okay. Once again, like I said, there are some little insignificant differences between the actual encumbrance or the encumbrance and the actual expenditure. Now, here is probably the most important slide in this entire lecture. You can see on the general fund, we're recording an expenditure and crediting a payable. At the same time that the general fund is recording this journal entry, the government-wide statements is recording journal entry 4D. And you can see the journal entry debit equipment, credit accounts payable. This is the first time, and there will be many more times as the semester goes on. This is the first time that you are seeing a difference between accrual accounting and modified accrual accounting. Rule of thumb with modified accrual accounting, we only record current assets and current liabilities. So in the case where we buy a fixed asset, we're buying some equipment. For the general fund, which uses modified accrual, we're unable to debit a fixed asset account. We actually debit an expenditure account. However, on the government-wide statements down here, we do use accrual accounting, so the equipment account can be recorded as a debit. Clearly, when these two journal entries are recorded side by side, one in the fund, one in the government-wide statements, clearly this is going to result in what I call a reconciling item. A reconciling item results because equity is affected differently at the fund level versus the government-wide level. You can see here at the fund level, equity or fund balance has decreased because we recorded an expenditure. But at the government-wide level, equity was not affected at all. If you take a closer look at this journal entry, you will see that all we did at the government-wide level was increase an asset and as well as a liability. We did not affect equity at all. So that difference in how equity is treated, how it's affected, is going to be noted on the reconciliation. And remember, when we looked at the City of Boca Raton's CAFR in an earlier lecture, there are required reconciliations to reconcile the equity of the governmental funds to the equity of the government-wide statements. And this would be one example. Journal entry 5, you can see above 5 it says general fund and governmental activities. This means that this journal entry is the exact same at both the fund level and the government-wide statements. All we're doing here is we're paying our liabilities. We're debiting our liabilities and we're crediting cash. Journal entry 6. Now we're going to take a look at payroll. Payroll is the largest expense by far of a local government. A typical local government, and I am not kidding you, with compensation that would include payroll as well as benefits, it is close to 80 to 85% of all expenditures of a typical local government. That percentage may shock you, but it is exact truth. So here's the example. When we record the payroll, we're going to debit the payroll expenditures, and we will credit the accounts payable as well as due to the federal government and state government for any taxes withheld from employees' paychecks. As that journal entry is recorded in the general fund, at the same time, this journal entry is recorded in the government-wide statements. It's very similar. There are some differences, though. We actually record expenses and not expenditures. And as you can see, we're breaking up our expenses by function or program, and we don't lump them all together. Journal entry 7, where it's payday. So we're debiting the payable, crediting cash. All right, journal entry 8A. Once again, we have an expenditure to the federal government. This represents the additional payroll taxes that the government needs to pay. This would be the employer's share of FICA and Medicare, Social Security and Medicare taxes, basically what this is. Debit expenditures, credit due to federal government, that's what's recorded in the general fund. At the same time, in the government-wide statements, we don't record them as expenditures, but instead we record them as expenses. And as you see here, they are broken down by function or program. All right, so that is the payroll process. Now, property taxes. When property taxes are recorded, the government is going to use what is known as the net revenue approach. And what that means is we record the receivable for the gross amount of the tax billings, and in this case it was $2,653,061. However, what we do is we don't record the revenue at the gross amount. We're going to record the revenue at the net amount that we believe we're going to collect. Effectively, what the government is doing is they are doing their analysis of the allowance for doubtful accounts up front at the same time that revenue is recorded. All right, so debit the receivable for the gross amount. We will credit the revenue for the net amount we believe we're going to collect. And the difference between the two, we will credit the contra receivable, called the allowance for uncollectible current taxes. In your other for-profit classes, you call this the allowance for doubtful accounts. But in this class, just different wording, but it means the same thing. It's the contra receivable. This is the net revenue approach. This is different than the way you accounted for it using your in the for-profit classes, where you actually did this in 2 steps. If you recall, in your prior classes, you debited the receivable and credited the revenue for the gross amount, and then subsequent to that, you did an additional journal entry to debit bad debt expense and credit the allowance for doubtful accounts. Well, the government does not use a bad debt expense account. Instead, what it does is it shows the revenue at net. So, this net revenue approach is used at the governmental fund level. The net revenue approach is also used at the government-wide level. The only difference you see between these 2 journal entries is, once again, at the government-wide level, remember, all of our revenues need to be either considered program revenues or general revenues. And all taxes levied by the government are considered general revenues. All right, now we levied the tax and we sent out the tax invoices. Now we are ready to collect. And so the same journal entry you would see on the fund as well as the government-wide statements, we're going to debit cash, and credit the taxes receivable. Journal entry 11 is also pretty unique to governments. What the government does is it actually has a different account for current taxes receivable and delinquent taxes receivable. So after the current period has come and gone, what we will see is the receivables are now delinquent. So what we're going to do is the amount of receivables that have not been collected, we will actually record it in a delinquent taxes receivable account with a debit, and we are going to get rid of the current taxes receivable with a credit. At the same time, we're going to establish our allowance for uncollectible delinquent taxes with a credit, and we will get rid of our allowance for uncollectible current taxes. We will do so with a debit. So this is something that's also pretty unique to governments, actually aging the receivables in different accounts. And last but not least, what we have done is we've come to the end of the period, and the amount of revenue that we did originally record that we did not collect by the time the end of the year came, we need to reclassify that out of the revenue account with the debit, and we need to credit the deferred inflows. Once again, in order to recognize revenue at the fund level, we need to not only earn it, and in this case that means levy the tax, but we also need to collect it within the year or very shortly after, which typically means the 60 days after year end. If we don't collect it within that 14-month window, then we need to unrecord the revenue by debiting the revenue and crediting the deferred inflow. That is something that would be recorded at the governmental fund level because this is a modified accrual. This is a modified accrual concept. However, you are not going to see a journal entry 11B because once it's levied at the government-wide level, which uses accrual accounting, it is revenue. End of period. Okay. Now some of the taxes that have not been received on a timely basis, we're going to add some interest and penalties to that. And so also using the net revenue approach, we will debit the interest and penalties receivable at the gross amount, in this case $13,320, and we will credit the deferred inflows, assuming we didn't collect it in a timely manner, and so that would be a deferred inflow. At the net amount, the difference between the two, we will credit the allowance for uncollectible interest and penalties. That is the contra receivable, similar to allowance for doubtful accounts. And then journal entry 12B is recorded in the government-wide statements at the same time as that original journal entry was recorded in the general fund. You do see some differences. The difference is the interest and penalties receivable is recorded as a general revenue versus the governmental fund or the general fund. You can see it was recorded as a deferred inflow. We can't record it as revenue until the period when we collect it. All right, now we are collecting the delinquent taxes. So in the general fund, which uses modified accrual, we're assessing some more interest and penalties. Debit the receivable, credit revenue. Similar journal entry on the government-wide statements. It's just that all of our revenue is either general or program. So anything associated with taxes is going to be a general revenue. And ultimately, we are collecting on our delinquent taxes. For the general fund, we are debiting cash and crediting the receivable. For portion of the and of course the interest and penalties receivable for portion of the taxes, and in addition to that, we can now recognize the deferred inflow as revenue since we have now collected it. And at the same time, in addition to that, we have additional collections on our taxes and our interest and penalties. And that would be the same journal entry in the general fund as it is in the government-wide statements. So we have a lot going on there. All right. And then ultimately, if taxes have become delinquent and then interest and penalties have been assessed, and if we still don't collect, we would write off the receivables by debiting the allowance accounts and crediting the receivable accounts. In addition to this, foreclosure proceedings would start to happen. If you don't pay your tax bill, you are going to ultimately lose your house. And that's what's going on here. All right, so that is the major revenue source for local governments, property taxes. Now let's take a look at some other revenues. And as other revenues are collected, debit the cash account, credit the revenues. And then that was done at the general fund level. But at the government-wide level, we're going to debit cash. But remember, at the government-wide level, revenues either have to be program revenues or general revenues. As you can see here, all of the program revenues are considered charges for services. I should say all the charges for services are considered program revenues, and our taxes and our miscellaneous are considered general revenues. Tax anticipation notes. Let me explain this. Sometimes we start the fiscal year at a certain time, but we don't actually start to collect the tax revenue until later in the fiscal year. So there might be a few months where we're a little short on cash. And so what the government needs to do is they need to get a quick short-term or current loan from the bank. That is called a tax anticipation note. And if you know what the word anticipation means, that means that we are getting this loan from the bank in expectation or an anticipation of us receiving tax revenues really soon. And as long as it's a current loan or a short-term loan, both the general fund and the government-wide statements can record the same journal entry: debit cash, credit the note payable. If this was a long-term liability, you would not be able to record this journal entry at the general fund level. The government-wide level, yes, same journal entry. But the general fund level, debit cash, and the credit would have gone to other financing sources. Once again, at the modified accrual for the governmental funds, you can only record current assets and current liabilities, with a few exceptions. And if we are paying back the note, you can see it's very similar between the general fund and the government-wide statements. We debit the liability. We're going to debit the expenditures for the interest at the general fund level. At the government-wide level, we call them expenses for the interest. Okay, couple more topics, and we will be done with this lecture. Interfund activity is something that I want you to understand. Interfund activity, this would be transactions between funds, and they come in many flavors. Let me start with the middle bucket here. It says interfund transfers. A transfer is when one fund is giving money to another fund. There is no expectation of a payback. Think of it as a one-way street. One fund is giving money to another fund. So the fund that is giving out the money, they would record an other financing use. And the fund that is receiving the transfer would record an other financing source. That is non-reciprocal. Now, let's compare it to what's in the top part of this slide, called interfund loans. A loan is when there is an expectation of a payback. So if we are the fund that is loaning money to another fund, we would record a receivable from that other fund. If it's a current receivable, we would call it due from other fund. If it is a long-term receivable, we would call it advance to other fund. Now, if we are the fund that is borrowing money, we are going to record a liability. If it is a current liability, a current loan, short-term loan, we would call that liability due to other fund. If it is a long-term loan, we would record and call this liability advance from other fund. And now on the bottom, this is when there's actually a reciprocal transaction, or this is an actual service provided from one fund to another. Typically this happens with internal service funds, or it could happen between two governmental funds as well. In this case, the fund that is providing the service would record revenue and a receivable from the other fund. The fund that is receiving the service would record an expenditure and a liability due from other fund, or due to other fund. So interfund activity could be a transfer, it could be a loan, or it could actually be a service between one fund and another. Okay, let me back up. I think I skipped a slide dealing with grants. I wanted to show you this. Grants. Grants come in two flavors. A lot of times grants come as either one lump sum up front, and with that grant money we actually provide the operations that we need to. When we receive the money up front, we actually record deferred revenue. Okay, we didn't earn that money. We don't record revenue until we actually start to use the grant money. And then the other type of grant is called a reimbursement grant. This is where we need to spend the money up front and then put in for reimbursement and get the grant revenue on the back end. And get the grant monies on the back end. In any event, we only record revenues when we spend the money on its rightful purpose. That is called a qualifying expenditure. Okay, and one last item in this chapter, let's go through some permanent fund transactions. A permanent fund, once again, is when a donor donates money to the local government, and the donation comes and the donor says, you can never spend this principal. That is why it's called a permanent fund. However, the principal could be invested and the investment earnings could be used for a particular purpose. So let's take a look at this example. Journal entry number 1 is when the donor actually donates to the local government. In this first example, we can see that the donor donated some bonds in their portfolio. So the government is going to debit this account called investment in bonds. This would be an asset account. All right, and the bond came with a little bit of accrued interest, so we'll also debit interest receivable, and we will credit revenues. Now that bond is invested, and we are now collecting not only the $12,800 in accrued interest, but additional interest revenues that we are recognizing. So the permanent fund will debit cash and credit the interest receivable and credit the interest revenue. So all that's happening at this point in time is the permanent fund received the donation and is now receiving and earning interest revenue. Now comes the point where some of that interest revenue is going to be used for operations. So what the permanent fund is going to do, they're not the fund that's actually going to do the operations, but they are going to transfer those monies out to another fund that will use it for operations. So the permanent fund, when the permanent fund records the transfer out, the permanent fund will debit other financing uses, and the credit will go to cash. And then we start it all over again. So the next year, journal entry 4A, the permanent fund at the end of the period is accruing interest, so we'll debit interest receivable, credit interest revenue. In addition, at the end of the year, the face value of our bond has increased in value, so we will debit the asset account, investment in bonds, and we will record the revenue with a credit for the positive change in fair value. And then 4C, you can see that the interest that we've generated in year 2 is going to be transferred out to an operating fund. Debit other financing uses for the transfer out, and we will credit, well, cash if we were actually going to make the transfer right away, but if not, we will credit this liability account called due to, in this case, library operating fund. Most likely this is a special revenue fund, and that money will be sent over to the library for operations. And then, last but not least, here is your closing entry for the year. We will close out our revenues with debits. We will close out our other financing use with a credit. And you can see everything gets closed out to the equity account fund balance. And as you notice, everything gets closed out to non-spendable. Non-spendable. The whole idea of a permanent fund is these monies are non-spendable. So that's why we close everything out to non-spendable fund balance. If some items were allowed to be spent, we would probably close it out to at least, at a minimum, assigned fund balance. Okay, so that's an example of typical transactions that you would see in the general fund, as well as a permanent fund. I also talked a little bit about some grants, talked a little bit about some transfers. So these are typical transactions that we would see in these governmental funds. As we move forward, we're going to have a full chapter on capital project funds and another chapter on debt service funds to round out our governmental fund chapters. And then we're going to move on to proprietary funds and fiduciary funds before we finish up with our Chapter 9, which deals with the basically the government-wide presentation and the fund presentation. We go through reconciliations. That's kind of like the final exam, the final chapter dealing with governmental accounting before we move into some nonprofit studies. Thank you very much.